President Joe Biden recently reselected Jerome Powell to lead the Federal Reserve in his second term. And while President Joe Biden wasn't around the first time that Jerome Powell was selected to the Federal Reserve chair, he now is actively choosing Jerome Powell. So today I want to take a look at what Jerome Powell and the Federal Reserve has done over the last 2 years and why Joe Biden may have selected him over anyone else. Joe Biden and his administration also have some pretty high hopes for Jerome Powell and a long list of things for him to do. And today we're going to be discussing those things and how likely we are to see them in 2022. But before we break all of this down, my name is Nate from Minority Mindset News, and if you like this video, make sure to smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world. We can keep making videos just like this one. The Federal Reserve is essentially the central banking system of the United States. It handles a lot of the monetary policy and decides how big our money supply should be. It also decides how much money we should print and how little money we have in circulation. The Federal Reserve was created back in 1913 and did 3 things. It stabilized prices in the United States, maximized employment, and moderated interest rates. Today it does that and a lot more, and it also helps to control inflation, monitor inflation, and works with banks all throughout the nation. But the biggest thing that you need to know here is that the Federal Reserve works with money, and it has for a very long time now. But even though it is called the Federal Reserve, it's not technically a federal entity of the US government. It is a private organization that works with the Treasury Department of the United States and the Labor Department. So in essence, the Federal Reserve basically decides how much money should be printed and decides a lot of our monetary policy, and then the Treasury Department actually circulates and oversees all of that money printing. The Federal Reserve doesn't actually print the money. The Treasury is the only entity in the US that can do that. But the Treasury can't just print money on its own. It has to have an order from the Federal Reserve. Originally, Jerome Powell was selected by President Donald Trump in 2018. So he has now served under 2 presidents, but as far as politics and administration goes, Jerome Powell and the Federal Reserve is supposed to be on the side of our economy and on the side of Americans, not on the side of administrations and politics. But as a lot of us know, this can be a big gray area. So we're going to now talk about all of the things that Jerome Powell has done in the last 2 years. At the very beginning of Jerome Powell's first term, he didn't really do much. The Federal Reserve and the United States was pretty much coasting as our economy was booming. This, of course, was all before the pandemic. As a matter of fact, in 2017 and 2018, the Federal Reserve actually raised interest rates 7 times. This means when the Federal Reserve raises its benchmark interest rates, it's a lot harder for people to have access to money. That means a lot less people are going to get loans, like mortgages or auto loans. This, of course, was all a slow response to what happened in 2008 and the Great Recession. Believe it or not, the United States was reeling for a very long time from the Great Recession, and they made a lot of monetary policies that were not Jerome Powell's at the time, but the Federal Reserve made a lot of monetary policies that affected the nation. Lots of money printing and bailouts went to big corporations. In addition, they also bought billions of dollars worth of bonds on Wall Street. So as the economy was improving and starting to boom in 2015, 16, and 17, the United States and the Federal Reserve decided that interest rates needed to be raised because things were starting to get better. However, pretty much everything changed once the pandemic hit in March of 2020. In March of 2020, a large portion of the United States was completely out of work. Industries shut down as we went into economic lockdowns and social distancing orders. So for many months, people were out of work. People out of work means no money is circulating throughout our economy because nobody has any money to spend. And on the flip side, businesses are now going to make less money because nobody is spending any money. This ultimately could send our economy into a collapse because if nobody is spending money, then our economy can't really work. We live in capitalism, which means our economy runs on capital and money circulating around. So spending ultimately grows our economy. However, people couldn't spend, and people didn't have any emergency savings in their bank accounts to protect them either. But it wasn't just people. Regular people and companies, even some big corporations, were running out of cash just weeks after the pandemic started. Big industries and companies like the airline industry. So with nobody spending money, they were pretty much shutting down. And nobody was really sure how long this pandemic or economic lockdowns were going to last. If companies go that long without money, then we could see long-term effects because companies will close down for good. And that means those jobs are permanently eliminated. So this was the Federal Reserve and Jerome Powell's time to shine. They decided to adjust monetary policy and turn that money printer on. They ultimately worked with Congress to create trillions of dollars from nothing. So they printed around $3 to $5 trillion in stimulus. This stimulus was direct checks to Americans. Some Americans got thousands of dollars in stimulus checks that they could go out and spend however they wanted. In addition, we had things like the Paycheck Protection Program. Now this was more for businesses, and it basically said that businesses could get free money as long as they didn't fire people. So if they held on to people and allowed them to work, the government would supplement some of the profits they were supposed to make, and they'd have enough money to keep products on the shelf and pay their employees. In addition, we had extended unemployment benefits. So on top of state benefits, the federal government was going to give you more money, and this was all printed money from the Federal Reserve. So what exactly did all this do? Well, it did two things. One of those things was essentially lift our economy. So this gave people thousands of dollars to go out and spend. Now, to be fair, a lot of people ended up saving this money. We saw saving rates go up by around 50% in 2020. That's the fastest and largest increase year over year that we've ever seen. We also saw the stock market boom in 2020 as well. First-time investors were flooding Wall Street and trying to make their money work for them. So not everybody just spent. A vast majority of Americans did spend this money. Now this keeps our economy going because now money is circulating throughout the economy again. However, this is all fake money, and it's definitely not free. The other thing that all of this money printing did was raise inflation. Inflation occurs when the government increases the money supply. So that means there is more money in circulation and all of the combined dollars are losing value. Think of it this way. If there was $100 circulating throughout the United States and that was it, and you had around $1, that means you would hold around 1% of all of the wealth. Now, if nothing changed, that means this would be great. Everybody would have the same amount of money and everything from a price perspective could stay exactly the same. However, we don't really live in a vacuum. And when the Federal Reserve decides to print even more money, so in this case, 100 extra dollars, now there's $200 circulating throughout the economy. Your $1 is not worth the same as it was before. That means your buying power went down. In order to have the same buying power that you did before, you need one additional dollar. And when the Federal Reserve does this with trillions and trillions of dollars, well, that's going to cause inflation to go through the roof. And one of the biggest symptoms of inflation is that the prices of goods and services are steadily going to rise across the country. So even though goods and services aren't really changing, you're naturally going to have to pay more for them just because of inflation, just because the money supply was increased. This is exactly why your grandparents could buy a movie ticket, popcorn, and a drink for around $1, but today it would cost you around $30, depending on where you live. And inflation is pretty much always constant. Inflation rises by around 2 to 3% every year because the Federal Reserve is always printing money. They're printing money for a variety of different things. One of the biggest things is to fund bills. As the United States takes on more debt, meaning they have programs that they need funded, or they're buying things from other countries and working with private industries, they're going to take on debt. And all of that debt needs to be paid back, so the Federal Reserve has to print money. Normally though, this is under control. Inflation typically only rises by around 2 to 3% every year. So if something costs $1 today, a year from now it might cost $1.02 or $1.03, which is pretty manageable. Nobody really likes it, but it's slow and contained, and this is what leads us to the first thing that the Federal Reserve influences in our economy: jobs. Jerome Powell and the Federal Reserve don't actually make any policies or legislation that affect the jobs market. However, based on the monetary policies that they do make, this affects the job market. For instance, the Federal Reserve has a great deal of control over inflation. Depending on how much money they print, inflation will be at a certain rate. So, if inflation is at a certain rate, this leads businesses to have to pay their employees more. Most businesses will pay employees just enough to meet inflation. This is why so many people get around a 2 to 3% raise every single year. It's not much, and you're not actually making any more money, but you are barely keeping up with inflation. So, as all of the prices around you grow, at least your wage is growing too. But if that gets out of control and inflation gets out of control, businesses will no longer be able to afford to pay their people more. The Federal Reserve will have to step in and offer some more monetary policies. So let me continue with my story of what happened over the last 2 years. The Federal Reserve printed all of this money to help boost our economy during the pandemic, but it also caused inflation. Now, we don't really feel that inflation right now because a lot of that money wasn't directly printed, and not all of that money is going to be spent and in circulation all at one time. Eventually, though, we will start to feel the effects of all of this money printing once it's all in circulation. And that is going to happen eventually. So a lot of people weren't working in the early stages of the pandemic and they had money. So a lot of them were also bored, so they went out and spent money because they had extra money. Sure, things were great in the beginning, and a lot of people, the majority of Americans in fact, don't really know how to deal with inflation. So a lot of Americans went out and spent this money, which directly contributed to our current supply chain issues. All of our industries were closed, and eventually they opened back up. But they opened back up with a backlog of orders, and demand never really stopped. So people kept buying more and more things, and even today we are running into supply chain issues because people continue to buy more things. Demand is way up here, but a lot of our supply chain is broken. That has increased inflation a lot, which brings us to the second main thing that the Federal Reserve and Jerome Powell do: stabilize prices. So just like when it comes to businesses, businesses also control the flow of products, and if inflation is high, they have to price their products at a certain amount. This ultimately means that our consumer price index is going to show some growth, and it's going to show that inflation and prices are starting to rise in the US. Every single month, the Labor Department publishes its consumer price index. This shows how all of the prices in the United States for pretty much every industry are faring. Are they going up? Are they going down? And we know that on a month-to-month basis. The Federal Reserve will then look at these numbers and then decide what to do with its monetary policy. How does it address inflation based on this report? And in October of 2021, the Labor Department published a new consumer price index, and it showed that inflation was rising by around 6.2%. It measured this by looking at all of the prices in the United States for products. All of those products on average are rising 6.2%. That doesn't mean that everything in the United States is rising by 6.2%, it's just an average. And this is when Jerome Powell and the Federal Reserve came out and said that inflation is merely transitory. However, it is a lot higher than the Federal Reserve thinks it would be at this time. Now, what they mean by transitory is that it is artificial. The only reason inflation is so high right now is because of our supply chain issues. And that's it. However, they have completely ignored the fact that they have printed $3 to $5 trillion over the last 2 years. And that will have to be addressed sometime soon by Jerome Powell. And on one hand, Jerome Powell is right. Inflation is really high right now because of these supply chain issues. This is putting an extra squeeze on Americans though, because the price of pretty much everything is rising. pretty much uncontrollably. It's the Federal Reserve's job to make sure that prices are staying stable in the United States. And again, that has to do with inflation. So Jerome Powell and the Federal Reserve have printed a ton of money over the last few years. I like to think that the people in charge of the Federal Reserve and our federal government know what is going on. So if I know that inflation can get out of control if trillions of dollars are printed, then why did they print all of this money? Well, this is a tough answer because Jerome Powell and the Federal Reserve are in a really interesting position. On one hand, the United States economy was in collapse. If nobody was able to spend any money, then our businesses and people would have failed. We would have saw a lot of companies go out of business. And what would that ultimately have done? If thousands of businesses across the country started to go out of business, well, a lot of them are too big to fail. We saw this in 2008 with the Great Recession. All of the major automakers employ hundreds, if not millions, of people around the nation. If they go under and go out of business, then all of those people lose jobs. So the United States government supports them, and the Federal Reserve ends up printing money anyway. They print money to boost them and the economy. They bail them out. So a similar situation happened in 2020 with the airlines. Now it's a little bit of a different situation, but the bottom line here is that the Federal Reserve had to do something. That's on one hand. On the other hand, the Federal Reserve is supposed to have the best interest of Americans in mind. So printing all this money ultimately hurts the average American. So why would the Federal Reserve print all of this money? Well, this is because the Federal Reserve and the United States government ultimately needs inflation. I talked about this a little bit before, but when the United States government takes on debt, they have around $29 trillion in debt, by the way, they have to pay this debt off. But it's a little bit different when you are a country and you have direct influence over how much money is printed. If the value of our money kept going up because the Federal Reserve wasn't really printing any money, then all of this debt would be nearly impossible for the federal government to pay off. It would get much more expensive every single year. But that is not what happens. Our money gets devalued every single year because the Federal Reserve just keeps printing more. So that means the United States government is able to pay down its debt with cheaper dollars. All of its money that it's using to pay down its debt is all becoming less valuable, and it's cheaper. If it didn't have this, the United States government would default, and it would basically go into bankruptcy, which is pretty much unheard of for a major world superpower like the United States. So the United States government needs inflation, and the country needs inflation in general. However, inflation hurts the majority of Americans because the majority of Americans don't invest their money. Investing is a way for people to grow their money faster than what the inflation rate is. Over the last year, the S&P 500 is up by over 31%. That means your money can grow by 31% instead of lose value, like if you save it. But a lot of Americans don't know this because they think investing is super risky. The Minority Mindset, though, we always talk about how not investing is even riskier. So with that being said, saving your money is ensuring that you're going to lose value on your dollars every single year. Average interest rate on a savings account is around 0.05%. This is why they call inflation the hidden tax on Americans, because most Americans don't really know about it and they're going to lose a lot of their money. The Federal Reserve knows this, but again, their hands are tied. For the greater good of the economy, at least in their opinion, the right thing to do was to print all of that money. If the federal government let all of these businesses and people fail, our entire economy and system would have collapsed. Now, an argument could be made for if they overstepped their bounds and if they printed way too much, but the bottom line here is that Jerome Powell and the Federal Reserve printed all of this money. And they did one more thing, which brings us to the final thing that the Federal Reserve controls: interest rates. I mentioned before how in 2017 and in 2018, the Federal Reserve actually raised interest rates about 7 times. Well, at the start of the pandemic in March of 2020, the Federal Reserve dropped its benchmark interest rates. and it dropped them to near 0%. Raising interest rates means a lot more people will not have access to money. They can't go out and get a loan because they couldn't afford the payments because of the interest rates. The interest rate is how a bank or a financial institution actually makes money on the loan. If you think about it, if you took out a loan for $100 and the bank only asked for that $100 back, no additional payments, then at the end of the day, all they would have is their $100. They didn't actually make any money. So these institutions will charge you interest. And if interest rates are lower, that means people could get a loan and stretch themselves a little bit further than they probably could before, just because these rates are low. And when Jerome Powell dropped interest rates, that meant that a lot more people went out and got loans. Specifically, people went out and got mortgages. We saw the biggest housing boom in over a decade because interest rates were so low. Typically before this point, interest rates were around the 5 to 7% mark, and that's on average. Some were a lot lower than that, some were higher than that. But for your conventional 30-year fixed loan, you've got an interest rate of around 5 to 7%. However, people nowadays are getting a mortgage with an interest rate of around 2.8%. That is incredibly low. I mean, you're essentially cutting your interest in half here. And that means that people are saving thousands and sometimes hundreds of thousands of dollars throughout the lifetime of their loan. So basically, when Jerome Powell and the Federal Reserve decided to drop their benchmark interest rates, this meant that they wanted to incentivize people to spend more money. Again, that's how our economy works, and it also incentivized banks and other financial institutions to give out more loans. That creates more money, which needs more money printing. So ultimately, Jerome Powell and the Federal Reserve has done a lot over the last 2 years. And love him or hate him, he is back for another term, despite all of the controversies. Jerome Powell also banned stock trading amongst its board of governors. So essentially, the Federal Reserve has a bunch of satellite locations all throughout the United States, and the head of those locations are called governors, and the people in charge of those locations are called governors. 2 of those presidents in Boston and in Dallas were caught allegedly insider trading in 2020 and in 2021. Those 2 ended up making millions of dollars because they had some insider information on future Fed policies. And they were also buying bonds, the same bonds that the Federal Reserve was buying. So they pretty much knew that it was going to be a safe investment and they could continue to buy them as long as the Federal Reserve was doing so. What makes it potentially insider trading is that they know when the Federal Reserve is going to stop this policy of bond buying. And they know when this is happening so they can pull their money out. Now, both of those Fed governors decided to resign, and legal actions are following, but Jerome Powell was the one to kind of stop it. However, he was also kind of the one that knew that it was going on. Jerome Powell came out and said that all of this information was public and was given to him. Anytime a Fed governor makes an investment, all of that needs to be reported to the Federal Reserve. But it didn't really seem like this was a problem until it became public knowledge. So like I said, they decided to resign, but it was ultimately on Jerome Powell to kind of oversee all of this. And maybe they were not insider trading. Obviously, this is all speculation, and I don't really know the details of what really happened behind the scenes. But you have to admit, it does look a little sketchy. In addition, the Federal Reserve hasn't really done much to address a lot of these inflation concerns that people are having. Inflation in October of 2021 hit a new 31-year high at 6.2%. And the Federal Reserve basically just keeps saying that it's transitory. I mean, they have cut back some of their money printing, we don't see all of the stimulus, and we don't see all of the extended unemployment benefits anymore. And in November, they announced they would begin tapering their bond buying program on Wall Street. Yes, just like they did during the Great Recession of 2008, they were pouring billions of dollars into the stock market, which is called quantitative easing. Essentially, they would buy back bonds and treasury notes on the New York Stock Exchange. This is a way to stimulate the market and give a lot of these corporations free money. However, they're going to begin dropping that back too. So I can't say the Federal Reserve hasn't done anything, but they haven't really done much. Prices are still rising pretty much uncontrollably in every industry that you can imagine. And all of this money printing is going to catch up to the country eventually. Now that Joe Biden has reselected him, he has given him two major things that he needs completed. For one, Joe Biden wants Jerome Powell to work on maximizing United States employment. So he wants Jerome Powell to create monetary policies that help incentivize businesses to hire more people. And there's a lot of different ways to do this, but ultimately it comes down to money printing. How much money you're going to print, or how little money are you going to print? In addition, what will interest rates be like in 2022? If the Federal Reserve decides to raise interest rates too quickly, then this means that businesses are going to have a hard time getting loans too. And a lot of businesses take on this debt in order to gain more employees and then just pay it back later. So it helps a lot of businesses to grow, and it can help a lot of small businesses start in the first place. So for 2022, interest rates will be key for Jerome Powell. Right now, the Federal Reserve has announced that they will raise interest rates at least one time in 2022. But this really all depends on what goes on with inflation. If inflation continues to rise and we do start to see the symptoms of all of that money printing next year, the Federal Reserve may really need to raise interest rates even more next year. Wall Street and businesses won't really like that because that means there's a lot less money circulating throughout our economy. But it may be the right thing to do to lower inflation. And that means that businesses, while they might not be getting as much money, can start to bring a lot of their workers back. And then Joe Biden wants Jerome Powell to work on inflation. So that's going to be everything all combined. So that means pricing, that means interest rates, and of course, employment throughout the United States. We are in one of the biggest labor shortages in our nation's history, and our supply chain issues are also historic. A lot of that can be helped out with money. The Federal Reserve can't handle everything, but between the United States government and the Federal Reserve, they should be able to get this problem handled. And seemingly, if the United States and Jerome Powell can solve the employment crisis, then a lot more people will have a lot more money. They can go out and spend a lot more money, and interest rates can naturally rise because people are a lot more wealthy. So when income goes up, that means people have a lot more money and they might not even need a loan anymore. And even if they do need a loan, they can probably qualify for a higher interest rate because their income is higher. So the bottom line is this: Jerome Powell is back, and he has done a lot over the last 2 years. From raising interest rates to lowering interest rates and buying billions of dollars in bonds from Wall Street. In addition, there was a Federal Reserve insider trading scandal, and 25% of all of the US dollars that are in existence were printed during his term. And remember, he's only been the chairman for one term since 2018. Now it's up to the Senate to finally approve him, and he can go back to being the chairman of the Federal Reserve. World is a lot different than when he first became the chairman of the Federal Reserve, and there is a lot of work left to be done. The Jerome Powell and the Federal Reserve has been in the news a lot lately, and I do not see that going away in 2022. But now I want to hear from you on this issue. What do you think about President Joe Biden reselecting Jerome Powell to be the chairman of the Federal Reserve? Do you think this was a great choice for our economy and inflation? Or do you think Biden should have definitely chosen someone else? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.